Welcome back everyone to Buffett Analyst. Today we're going to be doing something a little bit different than my last video, which was going through many different stocks and seeing if any of them were undervalued. This time around I'm going to take a more individualized approach, starting with one that may be potential and then kind of expanding and going deeper into the analysis to show you, what you can do when you find something that you like. I added to our speedrunning criteria, which is the criteria I use to have a short glimpse over the stocks to see if they're worth looking into. I added, is it a one-of-a-kind business with little or no direct competition, where similar companies grow by directly taking away customers? So what direct competition means is that there's two companies or more, and then the similar companies with similar products and services take away customers from each other. So an example could be OPRA operating software and Windows operating software. A customer can't have both. They have to choose one or the other. So therefore, customers of Windows are taking away potential customers of OPRA and vice versa. Another example that isn't direct competition, but is still competition, are, let's say, Nike and Adidas. People only own, one car, one operating system, but they can own multiple shoes. So potentially, a customer of Nike can also buy Adidas. It's not mutually exclusive. So I think that for businesses that have little or no direct competition, that's always a good sign, because that means that they're making products that they can price at more flexible levels when they don't have any companies that they have to worry about directly taking away from their income from customers. So I added that to the end. So now I'm going to show you guys a little bit about a new company that I found, OPRA. This company is an operating system, is sort of like Windows. I'm going to quickly set this up. All right, so OPRA basically caught my eye because I found it on this screener where it has a larger return on assets and equity, which means it makes more income on its assets as well as assets minus liabilities. It has a PE ratio of under 20, which means the price over earnings is under 20, and that is equivalent to saying the earnings yield is 5%, and that is a benchmark that I'm using because the interest rate is 5%. Then EPS growth for the past 5 years, that's earnings per share, is over 10%. And the final criteria I put into this website was it has to be at least over 300 million market cap, because anything below that you'll find very inactive stocks, and those can be super volatile in downturns and possible recessions. So I'm going to find the ticker. There we go, OPRA. So this is where I found it. It has, according to this website, return on assets of 18%, return on equity of almost 20%, dividend of 6%, quite good return to shareholders, which goes back to my criteria of a company being shareholder-friendly. And finally has a PE ratio of 6.75. So I don't know, I'm going to look more into it, where they got the earnings to get that PE ratio, whether or not the return on assets and equity is accurate. But this caught my eye, and now that I'm looking at it and seeing that not only that they have a dividend yield of 6%, that they also repurchase their shares, which, if you remember from the last video, that repurchasing shares decreases the amount of shares outstanding. And so that means that each share that you hold increases in value because the earnings is spread out over a smaller number of shares. So there's more earnings per share. So those were two great signs that this is a shareholder-friendly company, that management has a commitment to returning value to the shareholder. And that is a very important aspect that people like Warren Buffett look at for more long-term investments. The next thing that I will look at, though, so this I've caught you up to date with where I'm at with OPRA. I'm going to now walk you through step by step how I would determine if this company is worth even going deeper into. So invested capital. This is something that I touched on videos inaccurately, so I'm giving a correction on how I define invested capital in previous videos. So what it actually is current operating assets minus non-interest-bearing current liabilities, which has to do this parentheses, and then plus goodwill and intangibles, and plus PP&E, which is plants, property, and equipment. And what that'll tell you is what the total assets, operating assets that the company uses for daily operations and growing the brand. What current operating assets means are, say you went to the SEC, a great website for looking at financials, and I typed in OPRA. So I'm going to show you a quick example. It's a foreign company, so you'd click 20F for a annual 10K, for an annual report. And I'm going to go to financial statements. All right, and then now I'm going to look at the balance sheet. So right here it said current operating assets. So what does that mean? Up here in the assets part of the balance sheet, you'll find current assets. And you can tell because you'll find things like cash, marketable securities, all in one place, and receivables as well. Now, operating assets are specifically what the company is using to operate with, not their leftover cash, not their investments, but their, say, receivables that they are using to run their business day to day. And that would be a current operating asset. Prepayments is usually not included. It's also a smaller amount, so it's kind of negligible, but either way, prepaid expenses are something that's not recommended to use in asset value calculations by the authors of Security Analysis, which is the book that I'm using for evaluating stocks. So right now, the current operating assets, if we follow this formula that CFI gives us, that's going to be trade receivables at 58 million, because this is in thousands. It will also include this number, current receivables from sale of investments. So, but no. Now, if you look at this, it says sale of investments. And there's actually a very convenient note that explains what this means. So trade receivables is defined here, right here. Receivables are derecognized Other receivables are initially measured at their fair value plus, in the case of a receivable, not at a fair value through profit and loss, transaction costs. So it seems like if we go back to the balance sheet, that the sale of investment is not an operating asset because, like I said, the securities and investments they own are not necessarily used for day-to-day operations. Receivables, on the other hand, are. So 58 million. Other current receivables, we're gonna set that to 0. We're gonna set that to nil because that's not explicitly defined. Other, you have no idea what other could mean. And we're not going to include these bottom 3 either, marketable securities, cash, and prepayments, because those are not operating assets, current operating assets. So 58 million. So I'm going to type in 58 for the calculator later on. Minus non-interest bearing current liabilities. So what that means there are liabilities that cost interest to hold. That can be a bank deposit, where a bank has to pay their customers savings rates to hold their deposit. It can also be bonds, where a company issues debt to the public via senior securities, and let's say they have to pay customers a 5% interest every year, like sort of like a treasury bond, like a T-bill. Then non-interest bearing are ones that don't take an interest to bear and don't take interest to hold those liabilities. So if we go down here to liability section, non-current lease liabilities and other loans, well, this specifies current, so non-current would not fall under that category. These also both look like non-currents. Down here, though, are the current liabilities. So that's liabilities that have to be paid off in the next 12 months or less. Same with current assets. It's assets that are alive or that will be around for more than 12 months are non-current, and less or equal to 12 months are current. Let's see. So trade and other payables, deferred revenue, current lease liabilities, income tax payables, and other current liabilities. So which ones are we going to use for non-interest bearing current liabilities? Well, trade and other payables would not include interest. Deferred revenue would not include interest, but deferred revenue is not an operating liability. So I'm not going to include that. It's sort of like, excess cash. Current lease liabilities are interest bearing. So, and loans are as well. So that would not be included. So currently only this number. Tax payables would be included for sure. And other I'm not going to include. But since it's such a high number, I'm going to check out what is meant by other current liabilities. It looks like it's mostly accrued personal expenses, so I actually would include that into the calculation. So I'm going to go back, click here, nice. All right, so on the liability side, we're going to be including this, and this. So I'm going to subtract 47. I'm going to put this in parentheses, 47 plus income tax payable at 1.1 million plus other current, which is 12.2 billion. I'm going to go back up to the current operating assets and make sure that this number is accurate. I'm going to check out what is meant by other current receivables. There we go. So it's mostly unsettled trades, receivables from unsettled trades, amount due from brokers, from the sale of listed equity securities under the former investment program. So that would not be an operating asset because it's an investment based. And the other crypto assets. So it seems like other current liabilities would not be included in the operating part of this equation. I'm taking my time with this. In the future, I'm just going to do it automatically, but just to show you, because invested capital is a very significant number in determining the value of a company. So it looks like this is complete. We have negative 2.3 million. Now we're going to add all these and the plants, properties, and equipment. So that will be operating equipment. So property and equipment, this is net of appreciation and depreciation and amortization. So plus 14.6 is what it says on the balance sheet. And then goodwill and intangible assets are going to be 430 million plus 100 million. So I'm going to add 430. I'm going to add 100. It's 542. So I'm going to not include these because non-current receivables from sale of investments is not an operating asset. Other non-current investments are not operating, and deferred tax assets are the same as excess cash or revenue or things like that, deferred. So 542.3 is the total invested capital. That's in millions. Now that we have the invested capital, we can now determine the return on invested capital. And that will tell us how much you need to put into the company, how much operating capital you need to make money. And if it is a capital light business, then this number should be very high because the percentage on their operating invested capital, on their operating assets, minus the liabilities that we found, would be higher when there is more earned on it. So that is a good sign when you have a capital light model because they can recover in times of less liquidity or in times of trouble finding financing and trouble in the cash and assets areas. So what are their earnings? Financials. We're going to check quarterly earnings first, but I'm going to use yearly. So quarterly earnings will show you a pretty good idea about stability. You know, in a given year, what is their normal earnings? Is it going to be a big deficit? Should you consider that as a permanent or non-recurring deficit? But it seems like since 2022 or so, they've hovered around between 21 million and 14 million. And I'm going to go on the lower end and say that in their average quarterly earnings report, they will report 15 million because that's supported by this number, very close to this number, this number, this number. You see sort of this straight line that goes across. Let me see if I can zoom in. There we go. That goes across sort of right here in this level, 15 million. So 15 million times 4 is going to be 60, you got it. And then 60 divided by the total invested capital. So I'm going to do 60 over 542. And that will give us a return on invested capital or earned percentage on invested capital of 11%. Usually, for say a company like Ulta Beauty, this number would be higher, even at 20%. So OPRA has on the lower end of return on invested capital. So that is a consideration when thinking about purchasing the stock. Do you feel comfortable buying a stock with a moderately calculated return on invested capital? So what is the verdict on OPRA stock? Well, let's see. They've had many deficit years. Financials, and we'll see in the quarterly net income that they've had a deficit year in 2021 and in 2020. And they also in 2022, they had 2 more. So that's not always a good sign. And, they have these big spikes of earnings, and you want to see a little bit more stability. And even if we look at the net income, they've only really been profitable for, say, 6 years out of 7. And you see this giant spike, and then it's sort of up and down, and it's very unstable. However, let's see what happens if we look at revenue. Their revenue quarterly has been growing and growing and growing. And that shows that the company earnings may start to show growth as well. Revenue growth is a good factor in seeing if a past performance is a good factor in seeing if a company is undervalued. If you go to the cash flow statement and we see the net income and loss, it looks like it's also followed an uptrend. This year was higher than other years. So let's see, we found their normal earnings, which was this at 60 million per year. That differs from what is shown on this balance sheet. This actually says 160, but the reason why I put that number in is because the income quarterly statement shows a more nuanced, average. You see this very stable line of 15 million per quarter, with 4 quarters is 60 million. So what is OPRA's number of shares outstanding? Because right now I'm going to try to find the earnings per share, normal earnings per share. So looks like there's 89 million shares outstanding. So I'm going to divide that by 89 to get the earnings per share of 67 cents on the dollar. And the OPRA price per share is 12. So if we find the PE ratio, that would involve taking the 12.87 divided by the earnings per share, and that gives us 19. So that's not completely overvalued. 20 is the maximum price that the authors of security analysis would pay. 12 is what they say is a neutral outlook on the company. So this has given the company a very optimistic outlook in revenue. And that's justified by their revenue. However, not necessarily their earnings. And it seems that the company is overvalued in comparison to their normal net income. Because if you consider the fact that they've had so many deficit years and so much instability, paying a 19 PE ratio for the stock would be high. But you still need to factor in the fact that they return shareholder value. There is the dividend yield, which is currently at 6.2%. And in the past few years, they repurchased shares, which is shown by the number of shares outstanding going down. So the company repurchased shares off the market, and it's being held in their treasury, presumably so. So those two reasons would actually be in favor of paying a larger premium at 19 price per earnings for this stock. So those are some of the things that I keep in mind when I'm investing in stocks. The best way now to move forward, because I haven't given a verdict for myself even whether I would buy this, is to compare this with similar companies or other options of stocks, because very much so in investing you have what's called opportunity costs. By investing in one stock, you may forego the investment in another. So you want to find the best, most undervalued that you can, and put your confidence into that one stock. So I have another option that I have been considering in previous videos, which is Ulta Beauty. And Ulta Beauty, we can now take a look at and compare what their earnings are, as well as other values. But hold on, we may have a quick little problem. Okay, so I was actually using the wrong figures. I apologize. I was using 2022 figures instead of 2023. So this is a good practice. We're going to actually calculate their return on invested capital uno mas. So if you remember, current operating assets is going to include this value right here, trade receivables, not this because it's investments, not this because it's prepayments, not this because there's nothing there, and also because it's marketable securities, and not this because cash. So 69 is the lucky number, 69 million. Then current non-interest bearing liabilities. So we're going to skip this part because these are non-current, and we're going to go look at this because this is the current part of the balance sheet. So trade and other payables, that's non-interest bearing. Deferred revenue, that's more excess, and same with deferred taxes. I usually don't include those in calculations because they're more surpluses. And non-operating current lease liabilities and other loans, that is interest bearing, so that's not included. So far just this number is included in income tax payables because that's non-interest bearing, and other current liabilities, which if we go back and check what that was mostly consisting of accrued personal expenses, so that would be included. I'm going to go back to financial statements. So for the current non-interest bearing liabilities, we have this, and this number to include. So 52 million plus 1.8 plus 13.3. This is going to give us 1.9. And then now I'm going to add all the operating fixed assets, including intangibles. So PP&E, property and equipment, is going to get 16.1. Trying to use the same significant figures by rounding the 10th decimal point to the first decimal point, I should say. Goodwill at 430 million. 430. And intangible assets at 99. And the other ones I'm not going to include because these are non-operating. Investments, and tax assets. Equals 547. And if you remember, we got a normal yearly earnings of 60 divided by 547. And that'll give us 11% again. Now, if we wanted to use the current earnings, let's see. So this will give us some more education on the company. If we were to use current earnings, the net income being $160 million in 2023, we would get 160 divided by 547, which was the invested capital. And this would give us a return on invested capital of 29%. This is using the most current earnings, which may not be trustworthy because the current earnings does show a very exceptional year. For the industry, we have no idea yet if that is something that is exceptional across the whole board. But just for perspective, this is what it would be using the current earnings. So return on invested capital for OPRA is 29%. That is high, and that is a more argument in favor of the company. But now I want to do some comparisons. So what we look at is, what are the competitors to OPRA? Brave, Google Chrome, Firefox, these are other operating systems and browsers. Oh wait, is OPRA an operating system or browser? It's a web browser. Excuse me, it is not an operating system. So Google Chrome, Firefox, Safari, Brave. Does Brave have a stock price? It's not publicly held. It's privately held. So let's see. There would not be any public companies to put this up against. However, if we go to the larger area of software, and we can go to TradingView, packaged software, as the industry, all of these are companies which we can more comparably show OPRA against. So I'm going to start with margins, and the reason why is because if the company has a lower margin than the industry, then that could possibly mean that there's room for growth. So MSFT, Microsoft, packaged software, IBM, I'm going to do Salesforce. I'm a little bit familiar with them. I'm also going to include something that is around their market cap. I'm going to load more. SolarWinds, BlackBerry, competitor company stocks. Cheetah Mobile, Veritone Inc., this is an artificial intelligence company. Yeah, this does seem like packaged software. I'm gonna go for Veritone, and good. It has a low market cap. So I'm looking for something that has a lower market cap to compare against OPRA. Okay, so we see that in 2022 to 2024 there was increases in the margin. Now, this was an industry-wide pattern, especially with the advent of AI and larger demand in that area. So this is an exceptional year for the business. So this would more justify the use of a conservative current earnings rather than using 160, but using our normal calculated earnings of only 60, which would make the return on invested capital nearer to 11% than 29%. We can also check some other values against. Oh, wait. I typed in the wrong stock. There we go. Sorry about that. I'm going to recheck to make sure. Okay, Veritone. Okay. Also, I know C3 is another stock. Okay. So they've had declines in operating margins. It's at a negative because they're unprofitable. So this would probably not be a comparable stock because they're not profitable companies. Let's see. Ring Central. Remind myself what that is. Cloud-based communication. This does seem like a possible example. Compass Inc. It's a real estate brokerage. SolarWinds. Udemy. Just finding companies that could be comparable to OPRA. OPRA is right here. What is Karoo? Okay, this could potentially be Karo. Okay, there we go. All right, so Karo, this is going to be very different, very varying operating margins, but it seems like since Microsoft is definitely an outlier in their margins, OPRA is on the relatively lower end at 16%, so they do have room for growth. Let's see if we can find Chrome's operating margin. So if we type in Google, okay, 29%, that'll give us a little bit better of an idea. Yeah, it seems like Google, Karo, Microsoft, these are all places that OPRA can be relatively operating margin wise. Let's see the other types of margins. So operating margin means the operating income divided by the revenue. So how much operating income are they making with a given amount of revenue? Operating income means the income they make from their business operations. Gross margin, higher than all of these companies, which is interesting, except it's been falling since 2020. But it has sort of stabilized around 70 to 80%. Interesting. Margin, now we're going to try net profit margin. That's the same thing as net income margin. So OPRA is at the high end, almost at Microsoft's net income margin, which is very, very impressive. Yeah, these margins make the company look quite impressive. Yeah, all these companies definitely experienced major growth after the big 2020 boom. The question is, will that continue? We're going to check return on equity, just for kicks. Microsoft is in the highest, Google next, and OPRA at 17%, sort of the medium end. Return on assets, so this is the same thing as earned percentage on these values. Salesforce is once again at the bottom. Google, Microsoft, they're all sort of hovering between 16 and 20%. Pretty impressive for OPRA. Return on tangible equity, this is something that's not very good to rely on for a software company because most of their value comes from intangibles. And check shares outstanding on multiple axes. So OPRA is the only one besides for Google and Microsoft that have decreased the number of shares over time. Interesting. How about retained earnings? No? All right, I'm going to check the retained earnings. So retained earnings is the accumulated earnings after share repurchases and dividends. That is found on the balance sheet. Interesting. So they do pay dividends. So now let's do a quick new calculation, and then I'm going to wrap it up for today. One thing that you can figure out are the retained earnings, the true surplus. So those two words are the same, retained earnings and surplus. And what that means is the cash that's left over that gets accumulated by their net income, and it's on the balance sheet. It tells you a story that the income statement also tells, where you can compare the two types of net income, the retained earnings on the balance sheet and the net income that is stated on the income statement. So let's compare those two values right now. Let's first determine what the earned surplus is. So what the earnings tell us the retained earnings is supposed to be. So what we can do is take the past 5 years and add up all the net income. That's the first step. And the reason why I'm doing this is because I want to see how much money this company is making per year. What is their average year? What can we expect to see in this company? So right now I'm just adding up all the earnings, including the deficit years. Should be 44. I'm going to do it for the past 5 years since it is a relatively newer IPO. So 58 in 2019. 361 total earnings. But now we have to subtract the dividends paid, which can be found in the cash flow statement. Oh, so this is a new dividend, it seems. So the total dividends over the 5 years would be 23. So we should land on a number that's 338. This is the earned surplus. That should be 338. Now let's see what the indicated surplus is, which is what the balance sheet tells us it's supposed to be. And what we can do is find the change from 2019 measured at, let's see, what was the date that we had in the income statement? At December 31st. I'm actually going to go here. December 31st. So I'm going to line it up. Boom. About 100. And this is about 445. So what's 445 minus 100? 345. 338. So a discrepancy about 7 million, but that can be attributed to putting charges on the cash flow statement, or vice versa, putting profits on the earnings statement when they should be in the cash flow statement. There are many reasons why the balance sheet and the income statement would not quite align. But this gives us a good idea of what their true surplus is. And if we get a yearly value, we can get what we can expect in the surplus per year. So 338 over 5, which is the years we got. And that's 67.6, which is very, very close to our normal value of 60, normal earnings value of 60. And since they do use dividends, though, we can now add back dividends per year. So since they had a dividend last year of this number, 23. I'm gonna check that they're making quarterly payments as well. Yeah, so it seems like they're continuing the dividend. It's going to be about 20. So now we can add back to the retained earnings to get us the total earnings from the surplus. So 87.6. So we have a value between 60 and 87 as the normal earnings for this company per year. Just for just to compare, 87 would give us a return on invested capital of 16%. So still nothing to write home about. But this gives you a good idea of what are the things that you should look into when looking at stocks. And I know I said I would look into some more individual stocks, but we can save that for a later video as I dive into some more possibilities of stocks and I share with you some results. And let's see, is there anything else that I'm missing? I want to do one more invested capital calculation with you before I end the video. I talked a lot about Ulta Beauty, and I think this time I'm going to properly calculate the return on invested capital, just to show you guys a difference between this company and OPRA. So, starting with current operating assets, it's going to be up here, not including cash. We are including receivables. We are including inventories. We're not including prepaid expenses and other, and we're not including prepaid taxes. So these two rows are going to be what we use. So as of May 4th, 2024, it's the most current balance sheet value is going to be 203 million plus 1,906 million, which is the same as 1.9 billion. 2.1 billion is the current operating asset values. Now we're going to subtract the non-interest bearing liabilities, current non-interest bearing liabilities. So payable liabilities, yes. Deferred revenue, like I said, I'm skipping that. If you have these rules, you just got to make sure you stick to them. Current operating lease liabilities, that is interest bearing because it's a lease, and accrued income taxes is not interest bearing. So we're going to use this row, and this row. Using the most current values, we're at 464. So minus 464. Then we're going to subtract again 333. And finally, we're going to subtract the accrued income taxes at 93. The final step is to add the property, plants, and equipment, goodwill, and intangibles. So that's going to be plus 1196. Once again, then plus operating lease assets, 1562, plus goodwill. We've been using millions, so this is going to be 10 million, 11, rounded up to 11. And other intangible assets, this is a negligible value, so I'm going to not include it. And deferred assets, not included. And other long-term assets, not included. So the others, usually, if they're negligible, I don't include them because they wouldn't make a large enough difference in the valuation of the company that would change the margin of safety significantly. So 3988 is the invested capital. What is the normal income? Ulta. We have been using the current net income because of the stability and growth of this company. So if we use 1.9 billion, answer, we get a return on invested capital of 32%. So that is much higher than OPRA's return on invested capital. And that gives us an insight into the fact that this company takes less capital to run, which means it's more recession resistant and it is more efficient. It has better capital allocation. So this is just a good way to compare. For instance, if you were going to determine, oh, should I buy OPRA? Should I buy Ulta Beauty? Comparing, even though they're in separate industries, comparing their return on invested capital and other values gives you an idea of which opportunity cost you're going to sacrifice to invest in one or the other. You can invest in both, but either way, you could have still used the money you invested one to invest more in the other. So you always have to think about these opportunity costs. What's the best bang for buck that I can get? What's the best undervalued investment that I can get? All right, so I'm going to wrap it up. I hope you enjoyed that video. In future videos, I'm probably going to look into more finding, searching, browsing, and I'll walk you through the same types of things, probably a little bit faster, now that I've introduced some of the basic topics like growth, invested capital, shareholder-friendly management, things like that. So I hope you enjoyed, learned something, and I'll see you in the next one. Peace.